Hello, everybody. Welcome to this webinar brought to you by Wellford in collaboration with CLSA Securities Malaysia. So our webinar title today is RON95 Rates and Risk, How Policy and Interest Rate Shift Impact Your Portfolio. So my name is Shen Chu. I'm the moderator for this session. The limelight lately has been the RON95 subsidy, right? The targeted subsidy. Budi 95 was rolled out in late September. So what does it mean to your portfolio, right? So the price we pay at the pump and the interest on a loan and even the dividends from a bank share are all shaped by the government policies and the central bank actions. So today we're going to learn how this policy shift and interest rate changes can impact our portfolio. Now, today we've invited two speakers, respectively from CLSA Securities Malaysia. So we have two speakers. The first speaker, Jin Han, will talk about the outlook, and then the second speaker, Zach, will talk about how can you leverage on structured warrants to trade this market theme. So before we begin, as usual, disclaimer: whatever we share in this session is only for educational purpose. There's no buy or sell call in this talk. So if you decide to take any investment decision, you're solely responsible for all your investment risk. Allow me to briefly introduce our first speaker. Jin Han is a senior research analyst with CLSA Securities Malaysia who has amassed over 14 years of experience in the industry, covering various sectors but with a strong focus on financial institutions and banks. Prior to joining CLSA Malaysia, Jin Han previously spent time in Great Eastern as a senior credit analyst. So with extensive experience in the industry, Jin Han will share some key insights into the health of the Malaysian economy and the best barometer of it, the performance of the banks. All right. So welcome to this webinar, Jin Han. Good to have you here.
Hi, thanks so much for the opportunity and thank you for the invite.
All right. So I will stop
If
sharing
I
my
just
screen and hand over control
proceed
to you.
yeah, give me a moment. Yeah, so let's talk about rates for a moment. While I'm not exactly a trading economist, but I will try my best to at least explain a little bit of the broad-based movements that we've seen so far. So just taking a bit more of a zoomed out look across some of the region, we actually a lot of it actually originates from USA. So it all starts with the Fed. And when we think about rates, particularly when it comes to monetary policy easing or tightening, a lot of it is very macro based. So if you actually look at the chart on the top left, it does show the Fed funds rate, or at least the upper bound, where movements actually coincide with very serious events. So pandemic was the last most recent one, where you saw rates drop to near zero levels. A lot of this just to stimulate the economy and just keep things afloat, and followed by post-pandemic tightening as inflation started setting in, and the Fed actually had to step in as well to control that. Um, but lately, inflation seems to be easing a little bit more, and given the dual mandate of the US Fed, where they actually look at balancing between price stability and maximum employment, and given that employment figures have been worsening so far, we have seen some level of policy easing this year. There's probably going to be a couple more cuts down the line, and that does set the stage for other countries within ASEAN as well. So moving on to the chart on the right, where we actually do compare Indonesia. It's a really relatively similar trajectory that we do see. There's almost every major economy, including Southeast Asia, has seen a spate of policy easing due to the pandemic and tightening post. Where Indonesia does differ slightly is also because the currency actually moves and fluctuates on a very volatile basis, particularly when it comes to rate differentials between, let's say, the US Fed and the Indonesian interest rates. So how BI Bank Indonesia actually moves rates also has a certain element of managing foreign currency stability in it. So when we actually do see policy rate easing, a lot of it is actually a lot more controlled, particularly because they also have a certain level they have to keep in mind when it comes to FX movements. So there is probably a cut coming, and that should actually serve to help stimulate growth some more, particularly given Indonesian government's own policy to actually stimulate growth, and actually it's a very growth heavy policy for that government. Thailand is a relatively similar but somehow different as well. Um, in Thailand, a lot of asset quality issues in the banking sector, particularly related to households, where credit to GDP is actually one of the highest in the region. So, given that, as well as a weakening tourist market, coupled with current conflicts with neighbors, you're actually seeing Bank of Thailand actually having to ease rates to actually help maintain growth as well. So coming back home, in Malaysia, if you actually look at the how different the rates actually move compared to Malaysia, Malaysia's uh, central bank is relatively conservative, and they tend to move a lot less when it comes to rates. So you did see some level of easing in Malaysia and some level of tightening after the pandemic actually eased and subsided. Of late, you probably would have noticed that there was a 25 bips rate cut recently in July. So a lot of that actually was preemptive in nature. It's a little bit of a surprise for most economists, and a lot of it has to do with actually ensuring that growth is still on the docket when it comes to Malaysian GDP. So when we think about how at least the Malaysian central bank moves and how it dictates policy, it is a dual mandate for these guys. So for Malaysian central bank, the mandate actually is maintaining price stability, i.e. inflation, as well as encouraging economic growth. So ensuring some sustainable growth path. So it's actually maintaining a balance between these two figures, which is why in this presentation we do talk a little bit about a bit more about how inflation actually moves as well as how GDP does move. So there's a lot more plumbing that's actually involved with these two figures, but we just go broad based from here. Just a little bit of flavor in terms of trends, where we do see during the pandemic, you see quite a bit of deflation. A lot of it has to do with commodity prices that actually saw a lot of reductions, a lot of declines. Oil, as well as other commodities, also saw prices actually tank, particularly due to essentially the economy going into a standstill. And post-pandemic, you do see inflation rates actually spike. So a lot of this actually is not just commodities, also due to supply chain disruptions and the requisite effects on food prices. Some of this includes things like, fertilizers, uh, oil prices that do also that do get refined into other products, and that also has knock-on effects on the economy. But more recently, we have seen inflation actually start easing from 2023 onwards. Initially, 2022, a lot of the inflation actually came from F&B, food, and non-alcoholic beverages when it comes to the basket. More recently, that kind of inflation actually comes from housing and utilities and still F&B. But if we zoom in a little bit in terms of the chart at the bottom left there, where we do compare a little bit in terms of how RON95 might actually impact inflation. So the previous diesel subsidy that was removed had quite a limited impact on inflation. I think the estimated contribution to inflation was about 0.2%. So it did very little to CPI, and you didn't really see all that much movement. More recently, that change actually is driven by insurance products and insurance premiums, as well as F&B, more so than, let's say, diesel subsidies. So going forward, RON95, or at least when it gets removed, it's not expected to be particularly impactful to CPI. At least you won't actually see prices go up because it's actually been whittled down quite a bit. Now, I mean, from now it's actually extended to almost everyone with a My Card. So that does have a very limited impact and could actually be deflationary to CPI. So inflation, at least in the near term, is expected to be relatively weak, relatively low. If we zoom in a little bit in terms of GDP, how the economy is actually doing, we have seen quite a bit of recovery. That recovery story post-pandemic is essentially over, and right now, we are charting kind of an uncertain course a little bit due to tariffs. There is a possibility of some downside risk to global growth, and that does have some effect on the Malaysian market as well, particularly when it comes to exports. So, but we still are very well centered on private consumption, and we have had quite a number of investments actually come in. So that actually translates to infra projects that actually get built up, and that does translate well to GDP growth. So at least in the near term, we're probably going to see softer impact, but there's quite a bit of support coming from home domestic consumption in particular. The impact on RON95. So because it's also kind of whittled down, that also means that the government is still spending a bit more compared to actually a blanket release of the entire subsidy. So in that respect, we probably expect their fiscal deficit to be a bit more difficult to actually reach. So they have a 3.8% target, but our macro economists do expect them to miss this target by about 0.3 percentage points going to 2025. So oil prices also are relatively depressed. So that also doesn't bode particularly well when it comes to oil revenues for Malaysia. Sorry. So expectations going into second half and beyond. Our economists don't expect any kind of policy rate movement, at least within this second half of this year and next year. So it's pretty much going to be relatively stable on that score. GDP growth would probably be expecting quite a bit of support from private consumption going forward. The tariff impact uncertainty is still very much there. Semiconductors are a very crucial part of the Malaysian export chain, and that is still unresolved when it comes to tariffs on that score. So the impact to that is still not reflected in expectations. But inflation in this year is expected to be much softer. So oil prices did play quite a substantial part in this. It actually dropped quite a bit this year. So that's actually translated to more muted inflation figures. So next year we do expect inflation to actually come back to, or at least normalize back to, let's say, 2% level. Yeah. So given this, Bank Negara pretty much has a particularly very conservative view of how they should manage rates. Given that everything seems to be still humming, the economy seems to be doing relatively well on a broad basis, and inflation doesn't seem to be out of control. It does look like we don't expect too much in terms of monetary policy going forward. Moving on, in the context of the banking sector, at least how rates do impact the banking sector. One thing is the general rule of thumb is that lower rates do encourage businesses and people to borrow more through loans. So whether this is people actually stimulating the housing market through mortgages, or whether businesses actually find it's much cheaper to actually take out a loan to actually expand their businesses. All of this has to do with lower rates. So in that respect, lower rates tend to lead to some improvement in terms of loans growth for banks. Um, Currently, there is a loans growth to GDP growth multiplier about 1.1 times. So let's say assuming in 2024 your GDP growth was like 5.1%, loans growth would have been 5.5. So assuming GDP growth would have been, let's say, 4.1%, it will be slightly above 4, probably 4.5-ish when it comes to loans growth for the entire banking system. So that translates well to banks. And it does drive credit demand. Um, how it impacts the margins, or at least bank essentially they call it net interest margin, which from a very broad basis is essentially your how much you're making in terms of interest income, less how much you're actually paying out in terms of interest costs. So rates movements, especially expectations, have quite a bit to do with how this actually impact banking sector margins. So if you actually look at the chart on the top right, and you look at the funding cost curve, which is the blue line, or at least the darker blue line, you do see a rise in terms of funding costs. So this has to do with not just rate increases over the course of that year, but it's also to do with specific banks actually taking a view where that, let's say, rates might actually go up some more, and then they actually start offering more deposits and actually start kind of spoiling the market in that respect. So that's actually translated to quite a bit of stickiness in terms of funding costs for banks. Yeah, so this is kind of a little bit of a case study in terms of how expectations from the respective banks can actually impact overall market trends as well as the entire industry. So given that we do have a rate cut coming, near-term impact to banks will probably be negative as deposits start to reprice. Fixed deposits do take a while to actually reprice. Unfortunately, as retail investors, that actually means less income for us because board rates actually come down, promo rates also come down. But for banks, it's actually a good thing. And it actually helps them manage their funding costs. But naturally, the element of competition is still there. It's going to take a little bit of time for margins to actually normalize, which is why we expect some flattish margins going into next year as well. So in terms of rates, overall impact to margins will probably be more negative than positive. But there are other things that actually offset this, particularly when it comes to the other side of the coin when it comes to banking sector revenue. So if we're thinking about banking sector revenue, you do have net interest income, which is essentially stuff that you actually get off loans and bonds, etc. You also have non-interest income where you actually have, let's say, fees, investment securities that you might buy and sell, trade, things that you're holding on your balance sheet that somehow has improved has appreciated in value, and you decide to actually sell it for profit. Yeah. So under a declining rate environment, you do see a trend where suddenly things on the banking balance sheet does improve, does get bigger in terms of value. So essentially, you bought something and it's appreciated in value, and perhaps it's time to actually take advantage and actually sell it and realize that gain. So what we've seen so far has been not just due to rates, but also expectations that where government bond yields have actually come down. So banks actually hold quite a bit of government bonds in their books. So a lot of this is actually to both generate interest income as well as a relatively safe space to actually park your cash. So yields have actually come down quite a bit recently, over the past year or so, and that's actually translated to quite strong non-interest income for banks. So this provides a little bit of a balance when it comes to revenues. So net, we typically expect some kind of offset to banking sector revenues. In terms of rates, the impact to asset quality, essentially, the the convention is the higher the interest rates, the more stressful it gets. Naturally, if let's say you have a mortgage and suddenly the OPR actually jumps up by 50 bips, 50 bips or even 100 bips, even 200 or 300 bips, you probably see your mortgage payments actually balloon. You find, oh, I can't pay my loan anymore. I just can't afford it. And you eventually default and it turns into an NPL. So that's a loss for banks. So lower rate environment provide some advantage in terms of managing the health and financial health of customers. So lower installments does typically lead to a better financial health overall for customers. So that does help for banks, and the transmission of those rates does have knock-on effects to how banks actually make provisions, how they actually essentially is saving some of that losses for a rainy day. Yeah. But in aggregate, it's all interrelated. So if let's say we're thinking about rates and the requisite effects on GDP, you do have a little bit of a correlation to banking sector earnings growth. So if we could take home one thing from this is that rates do have an impact on GDP. The idea is to stimulate growth. And when GDP starts growing, you do see banking sector earnings growth. It does track. This track. So moving on to stock performance of at least the banking sector. Year to date, kind of in the middle, we're kind of 2.2% down on a year to date basis after last year's very strong performance. It's not too bad, all things considered, and banking valuations have actually improved since April. So if we look at the chart on the right, essentially it's the sector price to book ratio, which is how banks in across the world, not just Malaysia, are actually valued. So on a price to book basis, we do see an improvement in terms of those valuations from kind of semi lows, not quite the lows of the pandemic level, but still it has been low, one of the lowest in at least 2 years. So we've actually seen that recovery going forward. And that's also in line with improving macro environment in the sense that there's less uncertainty, people are more able to plan, and a lot of the knee-jerk reactions coming from tariff impacts seem to be cooling a little bit more. If I could leave with one thing, is that when we think about banking sector price to book valuations, they essentially move with banking sector profitability. So how if we could use one number to one metric to actually judge what's a good bank from a bad bank, return on equity would be that metric, and it's commonly used across the region. So historically, if we do chart, let's say from 2007 until now, valuations, or at least the transmission to stock prices, it does correlate very heavily with return on equity. That correlation is about 0.92 at this point in time. So the rule of thumb is if you expect banking sector profitability to improve, you probably expect stock prices to move accordingly. So that's probably what I like to leave everyone in the audience with in terms of that take-home point. Yep. And that's the end of my presentation. I'll hand it back to Shane.
Sharing with us about the macro outlook as well as the banking sector. So, moving on, I would like to invite our next speaker to share with us about the use of structured warrants. So, he currently heads the equity derivative desk in CLSA Securities Malaysia, and he has had stints with several financial institutions in Malaysia for the past 13 years and has extensive experience dealing with derivatives of various asset classes, including equities, FX, interest rate, and commodities. So he's none other than Mr. Zach Chui. Okay, Zach, how are you today?
Good. Thank you, Shane, for having me.
All right, cool. I'll stop sharing my screen and hand over control to you.
Thank you. All right, thank you everyone for attending our webinar tonight on a Tuesday night. Yeah, so as Shane mentioned, I'm Zach, heading the equity derivatives desk with CLSA. Very detailed broad market update and macroeconomic update from our colleague Jin Han earlier. Very interesting. I think from there, really like to share a few things. I think the first thing that struck us was of course how Jin Han mentioned that the rate cut cycle has all started from the US, and how that has a broader implication on both inflation and also so-called GDP growth. So what we show on the screen here is a very quick snapshot, I think, on that backdrop. And since Trump has come into power this year, how has the US stock market performed? Looking at let's ignore that blip in April where the infamous liberation tariff they happen. In fact, on the promises of a lower interest rate, this is what happened to the U.S. stock market. What we see on the screen here is S&P 500, which is a very broad-based gauge of how the U.S. Stock market is going this year. It has reached a higher and higher ground on the rate cut expectations, right? So this is something that may be worth keeping in mind as we move on to something closer to home. Again, this is KLCI performance the past year. Interestingly, the fall in April with the Liberation Day is consistent across both the largest economy in the world and ourselves. This is no less thanks to the fact that, as Jin Han mentioned earlier, Malaysia is a huge net exporter. So a tariff actually has quite a big implication on our economy. I think another thing worth noting is that you will have seen that despite the recent rally from post-Liberation Day to the current levels, we have just reached back to similar index level as what we have seen last year. This is both a very good sign in the sense that last year Malaysia actually was one of the better performing stock market around the world. So we have just gotten back to par where we started and have recovered a lot of lost ground. Hopefully this is a good sign of things to come, right? Drilling further down into sectors, right? Jin Han did share quite a bit on banks, profitability, you know, credit growth, and how banks would do in a low interest rate environment, mostly deriving better non-interest income. So this is a quick snapshot that I want to share here. On how the banks have done this year. As you can see, we have still not gone back to where the levels was last year, but compared to earlier this year, I think Jin Han summarized it very clearly that although it has underperformed the index slightly, it is really not the worst performing sector in Malaysia for the past year. It's slowly recovering lost ground, as some of you might have monitored recently. Meanwhile, another sector that was doing much better, especially given the recent rally for the past 2 weeks, is the tech sector. Again, the tech sector suffered a lot closer to Liberation Day, mainly because of the Malaysian semiconductor names being very huge exporters and really subjected to threats of tariff. What we saw recently is that the couple of good news. First of all, the AI spillover effects, where we saw that the data centers and GPUs and data center demands have slowly spilled over to the OSAT, which is the assembly and testing players that we have in Malaysia, and also on perhaps some more of the back end services and equipment that Malaysian tech names seem to provide are seeing an uptick in demand. So that has really helped the performance of some of the semiconductor and tech names that we see in Malaysia. The KL Tech Index, in fact, has done very well from April until now. Right, so these are some of the backdrop, and also another thing I really want to highlight is that in a low interest rate environment, tech stocks seem to do well. This is true across the world. This is mainly due to the valuation methodology that the finance industry use, either DCF or some kind of discounting methodology. Is a low interest rate input will always mean that you come out at a higher valuation because you just divide something with a smaller number. All right. So on that note, I would like to give a quick refresher on structured warrants, on how to trade some of these trends and some of the macro pictures that we have painted so far. How can we monetize these ideas and make a quick trade that hopefully can let you earn some money. Right. First of all, some quick refresh. If you are new to structured warrants, hope these slides will be useful to you. But if you are a seasoned warrant trader or have traded before, hope you find that these refreshers are useful. So what you see on the screen here is a very typical naming convention of a structured warrant. So structured warrants usually come in the naming format of a stock name followed by a C or a H and a number. Right, these are usually structured warrants. Right, so they are listed on the main board. They offer leverage return. They have an expiry date, meaning that a finite life. And there's actually two variety of structured warrants on the market, calls and puts. A put warrant will have a ticker code stock followed by for letter H. Right, for a call warrant, the stock name will be followed by letter C. So this distinction is quite important because a call warrant is essentially when investors hold a bullish view of the stock. If it's H or a put warrant, you hold a bearish view of the stock, meaning that you're thinking a stock will go down. All right, so all structured warrants are cash settled, meaning that you can't convert the warrants into the mother share during expiry. Right, this is not the same as company warrant. Company warrants are the type of warrants that you actually can convert to the mother share. Last thing to note is that structured warrants usually have no voting rights. Okay, so just a quick reminder on why trade structured warrants. We did an event recently where we got quite a few questions, why should I invest in structured warrants instead of shares? So the reason listed on the screen pretty much describes it, right? One of the major benefit of structured warrants versus buying the share is the low capital outlay. Structured warrants typically are priced below 20 cents, usually more closer to a 10-cent mark. So you can typically get, if you don't have a huge capital base, structured warrants could be a more beneficial instrument to trade. And given these low prices, they also provide leverage effects to allow investors to gear up their gains. Right, and it's easy to trade. Easy to trade in the sense that the trading procedure is exactly the same as trading shares. So you can log into your platforms or trade via your dealers and reminders for the structured warrants. And for warrants with good market makers / issuers like ourselves, there's ample liquidity, allow you to smoothly enter and exit the position, right? But I really need to highlight the fact that the two key things you have to take away from the two slides that I've shown earlier is that one, the finite life parameter, meaning that having a set expiry date on the warrants brings a very unique dimension of risk into structured warrants, meaning that you could have a correct view, but the view needs to be realized by the expiry date in order for you to make money. And the second thing is that leverage applies both way, both when you're making money and when you're not. So nothing shows better than an actual example. What we see on the screen here is a Unisem share price chart and also a Unisem C45, one of our own, and its performance over the past almost 4 months plus, right, from 21st May until 2nd October. Unisem, of course, has done very well. Anyone who has bought it late May, kudos to you. You have made roughly about 60% returns from a Malaysian tech stock. That is a stellar return. But if you have bought our structured warrant Unisem C45 instead, you will be up 154%. This is due to of course, the leverage effect of structured warrants. And just to illustrate the flip side of the coin is that this, of course, is also true when share price goes down. So unfortunately, we have on the screen here not so good tech stock that has suffered a bit this year, Genetech. The share price has gone down 15%, 1.5 in the period shown. It has gone down a little bit more since the chart was snapped. But just to illustrate is that the warrant has returned an even lower number compared to the underlying share during the same period. This is because of the leverage effect. Lastly, also very frequently asked question is that, if I hold warrant until maturity, what will happen, right? So again, like I mentioned earlier, you cannot convert the warrant into the mother share. So at maturity, what will happen is we will calculate the ending share price on the last 5 days preceding to the expiry date, and using the average closing price of these 5 days, use that to settle in cash against your exercise price. So for a very simple illustration, imagine you bought a call warrant with an exercise price of 1 ringgit. We'll assume the exercise ratio is 1 here, expiring on the 10th of the month. Right. So how we'll calculate the closing price or the settlement price is we'll take the closing price on the 3rd, 4th, 5th, 8, and 9. Of course, weekends are not counted. And use the average closing price on that to settle against the investors. Right. Something really, really worth noting is although the expiry date of this warrant is set on the 10th, as highlighted in yellow on the screen, the last trading date of the structured warrant is actually 8th. Imagine that you actually have an in-the-money warrant, right? And you are not sure whether you want to hold it and wait for settlement or you want to sell it on the market, right? The last day you can sell it on the market is actually on the 8th, it's not on the 10th, right? This is a feature that is worth taking note of. Okay. And moving on from there, that's quite a bit of info, but if in case you're a bit confused, feel free to drop us questions in the Q&A box, right? So moving on to the next step, there's a lot of a bit of theory going on earlier. We really want to show you how to trade, right? A step-by-step guide, how to trade warrants, hopefully CLSA warrants. I actually got some slides here, which I thought might not be the best illustration. So instead, I think I'll switch over to our website, and from there, maybe show you guys a much better illustration on how you can trade structured warrants, or use our website to find a warrant that actually suits you. Right. I hope everyone can see my screen at the moment. This is tradewarrants.my homepage, CLSA official warrant website. So if you have not used a website before, it has all the features that you need to find a warrant that suits you. Okay, so usually if you're brand new to this, what I would recommend is go to warrant tools under the warrant search function. Okay, and then from this page you can see that there's a few text box that you can fill in what you need. Usually you probably at this juncture hopefully have an underlying in mind. If you don't, you can scroll down and think of a stock that intrigues you. But usually when you come to this stage, you probably have done your homework and research and has a name that you thought, okay, I'm quite interested in this name. Okay, so for illustration purpose, I've used Pentamaster, which has also done well recently. Right. The rest are not limited and trying to show as many results as possible, but I don't want to be too biased, so I'm going to show all the issuers in town with their Pentamaster. Okay, so what you have is this has filtered out all the existing Pentamaster warrants that is on Bursa market at the moment, right? So from here, we want to filter out and see which one's the best for us. Luckily for CLSA, that's quite a simple function you can do this on. I think just for analysis, I would like a few more indicators. Premium is very commonly used, traded volume is very commonly used as well. So I added those two columns. And then once you have all the columns that you feel you need, you can just click this button here. You can export this search result as a CSV file. Okay, once the file is saved, you can open it. Okay, now I'm not sure if you can see my Excel sheet. One second. And what you have on the screen here is the search results that we have generated earlier. Okay, from here, I'm just gonna quickly go through with everyone here my personal methodology of how I would find a warrant that is the most optimum given what I have heard so far, right? First thing, I would of course do a bit of filtering um, on the results. The first thing to take note is we always try to avoid a warrant that is going to expire soon. This is mainly due to the time decay concern. So just to share a bit is that if a warrant is close to its expiry, even if the mother share price does not move, you can probably see that the warrant price will go lower on a day-to-day basis. This is a phenomenon known as time decay, and it's not a scam practice. It's mainly because of how these warrants are priced, right? So there's always a question asked by investors, especially now that call options trading seems to be very popular among some of the investors. So the question is, what's the difference between call options and warrants? The straightforward answer is that they are actually almost the same thing. Warrants are just smaller tickets of call options. So if you have explored or come across call option trading in some of your day-to-day finance news or friends trading these options, be assured that warrants and options are the same thing, and they are both priced using the Black-Scholes pricing formula. Right, going back to our search result here on the screen, I've removed the December expiry simply because it's a bit too close to the current time for our comfort. So we're left with the results here. Okay, so the usual practice at the moment, the prevalent practice by finance guru would dictate that you always choose a warrant that has the lowest premium, and then from there you should just buy the lowest premium warrant. All right. This exercise is actually not very accurate, right? Some people even touted negative premium as free money, right? This is actually not true. That's simply because the understanding of premium is very different in across different countries. At least in Malaysia, the SC's definition of premium simply means the percentage of the share of the warrant price that has to move in order for you to reach a break-even level. So this number will vary. The premium number will seem very low in two particular circumstances. The first one is if the exercise price of a call warrant is low, meaning that the warrant is in the money. Okay, so if you look at the negative premium warrant, you have noticed the strike price is surprisingly low. It's 2 ringgit and 70 cents. And if you go on to a 5.7% premium, the same is also true. These are very low exercise price, meaning deep in the money call warrants. Okay, another phenomenon is a low premium warrant tend to expire closer to the current date, means that it has a shorter time period to expiry. Again, also true, the two low premium warrant are the closest to expiry. Right? And of course, the most expensive warrant in this case, one of them is by us, is because it has a very high strike price. Also, it has a long period to expiry, resulting in what it seems like if you're just referring to the premium, an expensive warrant, but if you study the root cause of it, it's not necessarily true. Okay, so after knowing this, I always advise people who I speak to disregard the premium parameter when you're trading structured warrants. What you're looking for when you want to make money is choose a parameter that you're comfortable with. Just looking at two particular columns, namely effective gearing and sensitivity. Okay, so if you're looking at Pentamaster, you just want to gain leverage returns when Pentamaster share price goes up. I personally would go for a number that, from what we see on the screen here, 4 is the highest, 2.8 seems a very reasonable feature. And then by choosing this, we also want to study the sensitivity column. What sensitivity means is how many ticks does the mother share price have to move for the warrant to move one tick. So the catch here is the higher this number is, the more underlying share has to move in order to move the warrant price. So a lower number is better for us. So a high effective gearing usually come with a high sensitivity number. So you can think of it as there's no free lunch, right? So to get a higher leverage, you need to pay off some of the sensitivity. So it's always more sensible to not just go for absolutely highest gearing, but instead choose a gearing that you are comfortable with. Say, for example, here, I'm willing to give up 0.4 in terms of gearing, but for an extra 1 tick sensitivity. Right? Or if you want to study even further, this seems like an absolute winner. I know it's not issued by CLSA, but we need to be very honest, a 4 times gearing and a 3.9 tick sensitivity is an absolute winner for Penta C56. So given the current choice in the market, I know I shouldn't be pushing a competitor's warrant, but this is what I personally would think is a very decent choice for investors out there at the moment. All right, hope this simple illustration gave you some idea of how to select a good warrant. All right. And I just want to share one little bit before we hand the controls back to Shane. The last thing I want to share is something called the warrant matrix. Sorry, Shane, can you guys see the warrant matrix on the page?
Yes.
Okay. All right, wonderful. All right, what you see on the screen here is a so-called money shot from us, a warrant matrix. Again, it can be seen on our website. So on this page, there's three key things to note, right? The first thing is all the warrants key terms that you need to trade the warrant is up top in the red box that we highlight. Right, the exercise price, expiry date, and the gearing is shown there. You would notice that the sensitivity is not mentioned in this table. That's because you can refer to the breakdown in the table below for sensitivity. The different shades of color, when it shows the flipping points of each, the warrants price corresponding to each level of the mother share price, you can see the number of mother share price movement, the number of times that the ticks have to move for the warrant to move is the sensitivity. In this case, highlighted in the blue circle, it shows a sensitivity of 4. And lastly, if you have this table, it's a lot easier to plan your trades, how to take profit, how to stop loss. You can use this table really to your advantage and do a very disciplined approach to trading. And lastly, of course, just want to highlight the importance of having a good market maker. Right, we are, of course, the latest market maker in Malaysia. Total, there's 8 structural warrant market makers now. CLSA, of course, is one of the best, if not the best, liquidity provider in the market at the moment. If you have an active trading account, log in tomorrow morning, have a look, and you'll see why the reason is so. If you're not sure which are CLSA warrant, some platforms do show the issuer's name. If yours does not, you can always refer to our website. We have more than 115 structural warrants outstanding at the moment. And lastly, this is our website. And if you have questions, feel free to call us at our hotline as well, that's shown on the screen. And we are obliged to tell you that this presentation has not been reviewed by SC. So yeah, any questions, please direct it to us. Thank you so much, Shane. Back to you.
All right, thanks, Zach, for sharing with us about the use of structured warrants to gain leverage exposure in the market. Open the floor for the Q&A session. So if you have any question for any of our speakers, be it Jin Han or be it Zach, please write your question in the Q&A box. Okay, we have about half an hour to do the Q&A. Okay. So you can ask Jin Han any question in relations to the market, economy, and banks. And you can ask Zach about structured warrants. The first question, I would like to pose the first question to Jin Han. Okay. Thanks for staying through with us in this session. So the question asked by Eugene, uh, do you have any comments on the Japanese bond 10-year yield hitting all-time high? Now, given the new expansionist prime minister, is market pricing in a more spending from this new government? Now, given we know that Japan is the largest holder of the US Treasury debt, will they be forced to sell US Treasuries and buy back their own bonds to reduce long-term financing costs?
Sure. So I don't profess to be a particular expert nor an economist when it comes to the Japanese economy, but I guess conceptually, when we think about yields hitting all-time high, it has been increasing over time. A lot of this is also driven by the Bank of Japan actually initiating quantitative tightening measures and actually just slowing down bond purchases. So it still is the largest holder of Japanese government bonds. Um, Given that it was in the middle of a tightening cycle, they may be forced to relook, particularly when it comes to managing financial stability within the economy itself. So aside from Bank of Japan, insurers also are quite large holders of Japanese government debt as well as commercial banks. So the fact that yields are actually hitting such high levels and increasing still does have ramifications on financial stability. So there is a certain tightrope that they have to walk along. So it might not fall onto the Japanese government entirely. Bank of Japan, the central bank, might actually step in to go back to some level of yield curve control just to manage financial stability if they deem it appropriate lah. I'm not in any position to comment on what they will do, but it is something that they probably will be forced to think about if yields actually go too high. So another aspect of where we think about US Japan's holdings of US debt, given the political dynamics as well as who's actually leading the US economy, substantial thinning down of US debt might also be something to consider, particularly when it comes to political negotiations. So it is definitely something the government is thinking about. Market definitely has been pricing in more spending from the new PM, and B, it also has to do with uh, confidence also lah. So it actually has yields have actually been rising, or not just post the election, but even over the past few months as well lah. So just possibilities at this moment. Can't really comment too much on what they will do.
All right. Thanks, Jin Han, for sharing your perspective on this question. The next question I have on my screen is by Lim. So, what is your forecast of FBM KLCI by year end? What's the house target?
I'm not in a position to actually comment on market at the moment. So it's probably above 1600.
Okay, above 1600, right? Okay. So at the moment, do you think the banking sector is actually attractive to you?
I mean, as a whole, the banking sector has pros and cons. So it's actually a very good source of stability when it comes to the market. Um, Banks are still making money. They're still showing some level of earnings growth, even though it's quite modest. There is definitely more to look forward to next year than this year, and um, it would actually be more interesting if you look at it from a bottom-up analysis in terms of specific banks. I don't believe that there's a particular catalyst that will actually drive the entire sector up. But there are quite a few banking stocks that do look compelling at these levels given what's in store over the next few years.
All right.
So you're saying just Shane, just to add a bit more on what
Sure.
Jin Han and you mentioned, I think it's very interesting what Jin Han said earlier, and also given Lim's question is that the banking sector actually, I think we all know, are the heavyweights of the KLCI. So, I think Jin Han did not directly answer Lim's question, but, if you read furthermore into the comments, you can see quite well that given that there's no sector-wide catalyst for the banking sector in general, we probably will see that there probably is also not much room for the KLCI to climb much higher, unless there is some sort of broad-based kind of sector or countrywide catalyst that we see from the government or the private sector, a bit like the AI um, data center growth, how they drove the construction sector last year. We probably need to see something like that in order for the KLCI to break out of the current resistance level. And of course, for banks, it would mean that some kind of uh, initiative that can allow them to capitalize to make more money. Yeah, but there are banks that I believe are undervalued. And if you look through your broker's research report, the few candidates should be quite clear.
All right. So there are still opportunities now, huh? So in this regard, Zach, do you have any structural warrants issue on banking counters?
That's a very good question. We mentioned we have about just under 120 names issued over Malaysian. We actually only issue over Malaysian single stock at the moment, unlike some of our competitors who had index and a foreign warrants. We since launching on 25th April, we have solely focus on having a wide coverage of Malaysian single stock names. We currently do not have a lot of bank names, but we do have a certain picks that we like. We have two CIMB warrants. We also have Affin M Bank and also Public Bank at the moment. So we did not issue over all the banks, just a few picks that based on of course the competition with our colleagues in research, which are some of the best in the country, and also on some of the in-house views that we have. So we don't have all the names. Yeah, just to summarize this, but the few names that I mentioned, you probably would have guessed are probably the some of the CLSA's favorite banking names at the moment.
All right. Now, this week, the highlight should be the budget 2026, which is going to be tabled on this Friday. So, do you have any comments or expectation on this budget? Maybe Jin Han?
Generally, if we track historically, when it comes to budget announcements, especially when it comes to banks, there's very few freebies that are actually available that are directly positive or negative for the banking sector. So a lot of the announcements tend to revolve around uh, providing more facilities to actually aid SMEs, relief facilities, any kind of supportive measures that actually help drive financial inclusion. So these tend to be the more direct kind of goodies that banks can look forward to. But overall, whatever's generally good for the rakyat, whether it comes in the form of, let's say, supportive measures to manage cost of living, to some handouts, a lot of these things that are positive for the rakyat would generally be positive for the banks, because that ensures that at least when cost of living measures are well managed, people are earning enough wages, they can pay their loans. So when loans are in a good space, that's when banks get to flourish. That gives them a little bit more confidence when it comes to extending loans, especially when the macro environment is great. So banks generally benefit very indirectly from budget measures. So infra projects as well, if let's say that gets announced or more gets announced, then that also filters down to your SMEs, your smaller companies, and these companies do tend to take out loans more so than bonds, and that's positive for the banking sector lah. So in summary, extremely indirect, but as long as it's positive, generally the banks will definitely benefit.
All right. Thanks for sharing your perspective. Now, uh, uh, if the Fed does rate cut very aggressively, do you foresee that Bank Negara will follow suit?
I think when the Fed actually starts cutting rates, it becomes a question of managing financial stability. So how that actually affects Malaysian economy. So a lot of the time when it comes to rates, that also has quite far-reaching impact on exchange rates and FX. So when it comes to, let's say, managing that part of the economy, it really is ensuring that any kind of movement will be more gradual, and it managed rather than a sudden spike. So if anything, Bank Negara is not. I don't believe Bank Negara is particularly comfortable with sudden spikes in changes in FX. They're okay with gradual movements. So if it really depends on the pace of that reduction. So part of that is also what has driven the monetary policy, let's say during the pandemic as well, in terms of the pace of cutting. But generally, U.S. Fed rate movements don't tend to move very directly with Bank Negara's monetary policy. More so for other countries within ASEAN, not so much Malaysia. But the impact, if it impacts the FX quite heavily, then Bank Negara might actually step in.
All right. Thanks, Jin Han. I would like to pose the next question to Zach. Okay. Now, Zach, you are the latest issuer. I mean, CLSA is the latest issuer of structured warrants in Malaysia. But many retail investors are not really familiar with CLSA yet, like, because I think this is your first foray into a retail market, right? So maybe you can share with us a little bit about CLSA's background and branding, and what makes you different from the other issuer.
All right, good question. Thank you, Shane. Yeah, I think I should have covered this a bit earlier, but thanks for bringing it up. I think most of our participants probably have not heard of us prior to the event as well. CLSA has been around actually for a long time, since 1986. We were formed quite a long time ago in Hong Kong by two French journalists actually. These two journalists who were doing a bit of a finance coverage came to Asia in the late 80s, and they were reading some of the research reports that were being churned out, and they actually thought it wasn't very good. Right? It was very typical, and there offers not much insights into what is actually happening, both at the company level and also the economy kind of level. So they formed their own company to start writing research reports and covering some of the stocks. And of course, 80s there was a boom, and 90s in Asia there was a stock market boom. One thing led to another. The company expanded very quickly to serve a lot of countries in Asia. But the reason a lot of investors or retail investors have not heard of us, at least in Malaysia, is because in Malaysia and also through across many countries, we solely serve institutional clients. So for example, in Malaysia, our clients would be like the buy-side fund managers, for example, EPF, for example, public mutual kind of clients. So we have been serving these clients since we started business in Malaysia here in 2005. So for the past 20 years, after serving institutional clients, this year we are foraying into more of retail centric business like structured warrants issuance, which is why yeah, we're at the event here today.
All right. I remember CLSA when I went over to your website. CLSA boasts that you have membership in all Asian exchange, right? You're the only broker that have membership in all Asian exchanges.
Yeah, actually that's correct. Yeah, in Asia, our coverage is one of the widest, and also we are particularly strong, actually when it comes to China and Hong Kong, because our parent company at the moment is actually CITIC Securities, which is the largest investment bank slash security house in China. Yeah, so we do have a wide coverage of Asia Pacific, and on top of that, one of the biggest market in the world, Hong Kong, China, we are huge in those markets as well. Very knowledgeable and have expertise in those markets.
Excellent. All right.
Yeah.
It looks like no more question on my screen. Yeah. If you have any question for our speaker, you may write them at the Q&A box. Okay. We will try to answer as many questions as possible. Thank you everybody for tuning in for this webinar. Thank you so much to both our speakers, Jin Han for sharing with us about the market outlook as well as the banking sector. Thank you so much to Zach for sharing with us about structured warrants. Now we know how to use structured warrant better, how to use effective gearing, how to look at sensitivity to find the right warrant for us. Right. So with that, thank you everybody, and wish you all have a pleasant rest of the day, and see you guys in our next webinar. If you're in Kuching, do come to our event that will be held on next Saturday. Okay, bye bye.
Thank you, everyone. Good night.
Thank you.